The year was 1929. On the surface, America looked invincible. Factories ran day and night, newspapers celebrated endless growth, and the stock market had become a national obsession. Ordinary citizens, clerks, farmers, shopkeepers, were suddenly investors. Everyone believed the same thing: prosperity was permanent. But beneath the optimism, something was quietly rotting. Banks were lending money they didn't truly possess. Stocks were being purchased on margin, stacked on borrowed capital, inflated by confidence rather than value. Wealth was no longer grounded in production or savings. It was floating on promises, speculation, and leverage. Very few noticed the warning signs. Those who did stayed silent. Behind closed doors, a small circle of financiers began to move differently. While the public chased higher returns, elite money grew cautious. Gold was withdrawn from visible banks, assets were shifted quietly, cash positions increased. Risk was not eliminated, it was relocated. Then the system cracked. On October 24th, panic erupted. Prices collapsed faster than anyone believed possible. Within days, fortunes evaporated, banks failed, and confidence turned into fear. But here is the uncomfortable truth. The crash did not affect everyone equally. As millions lost jobs, homes, and savings, another reality unfolded in parallel. Institutions with privileged access converted paper losses into real control. They acquired land, companies, and political influence at fractions of their former value. Crisis became leverage. The public experienced collapse. The powerful experienced consolidation. Governments rushed to respond, but their tools were blunt and slow. Emergency policies were introduced only after capital had already repositioned itself. New regulations promised safety, yet they arrived too late to protect ordinary citizens and just in time to legitimize the new financial order. The Great Depression is remembered as a tragedy of poverty and unemployment, and it was, but it was also something else: a massive, silent transfer of wealth and power. Small banks disappeared, large institutions absorbed them, competition weakened, financial influence concentrated. What looked like chaos on the streets became order in boardrooms. This pattern was not accidental. 1929 revealed a hidden truth about modern finance. Crises do not destroy wealth, they redistribute it. Those closest to information, power, and liquidity survive intact. Everyone else bears the cost. By the time recovery began, the system had changed. Money was no longer just currency, it was control. Financial survival no longer depended on hard work alone, but on proximity to the architecture of power. And most people never saw it happen, because the most important movements occurred out of sight, inside vaults, private agreements, and ledgers never meant for public eyes. The Great Depression ended on paper, but its financial logic never did. It became a blueprint. And nearly a century later, as markets once again soar on debt, as confidence outweighs fundamentals, and wealth quietly retreats into protected spaces, the same invisible forces are moving again. The ghost of 1929 never vanished. It simply learned how to hide. When the dust of the Great Depression began to settle, the world believed it had learned its lesson. Governments spoke the language of reform, regulations were drafted, new institutions were created to prevent another collapse. On the surface, the financial system appeared tamed. But beneath the reforms, something far more subtle was taking shape. Capital did not disappear after 1929, it adapted. As public markets became more regulated, wealth simply changed its routes. Money, like water, flowed toward the path of least resistance, and that path led away from transparency. Quiet jurisdictions began to rise. small, strategically positioned financial havens offering one invaluable commodity: secrecy. These places did not promise higher returns or greater stability. They promised silence. Assets could be parked, ownership could be obscured, and wealth could be protected from political pressure, taxation, and public scrutiny. This was not illegal finance, it was legal design. The post-Depression era gave birth to financial structures that separated money from identity. Trusts, holding companies, and offshore entities multiplied. On paper, wealth belonged to corporations. In reality, it belonged to no one, and therefore to everyone who understood how to control it. Banks evolved alongside this system. They were no longer simply intermediaries between savers and borrowers. They became architects of concealment. Their most valuable service was not lending money, but shielding it. Confidentiality replaced disclosure. Complexity replaced clarity. While workers rebuilt economies through labor and taxation, elite capital operated in a parallel universe. Public systems funded infrastructure, wars, and welfare. Private systems accumulated protection, influence, and insulation from risk. Governments, burdened by debt and social obligations, slowly became dependent on financial institutions they claimed to regulate. Policies began to follow capital flows rather than public need. When markets trembled, states intervened. When citizens struggled, assistance came with conditions. The balance of power had shifted. By the mid-20th century, finance had become an invisible empire. No borders, no elections, no accountability to voters. Decisions affecting millions were made in private rooms across jurisdictions designed to fragment responsibility. Crises became features, not failures. Every economic shock created opportunity for those positioned correctly. Currency devaluations rewarded those holding hard assets. Market crashes eliminated weaker competitors. Public fear justified extraordinary interventions that quietly favored large institutions. Risk was never removed from the system. It was transferred downward. As decades passed, the mechanisms grew more sophisticated. Financial instruments multiplied. Derivatives, futures, and synthetic assets allowed exposure without ownership, profit without production. Value became abstract, detached from physical reality. To the public, finance became incomprehensible. To insiders, it became predictable. This complexity was not accidental. Confusion is a form of defense. A system too difficult to understand cannot be easily challenged. Transparency was replaced by technical language, legal barriers, and bureaucratic distance. Meanwhile, wealth concentrated. A small percentage of global actors accumulated disproportionate control over capital flows, credit access, and market confidence. Their decisions could move currencies, influence governments, and reshape economies without ever appearing on ballots or headlines. And still, the narrative remained comforting. Markets were said to be efficient, growth was assumed to be natural, inequality was framed as a temporary imbalance. Each generation was told that prosperity was just one cycle away. But beneath the optimism, the architecture built after 1929 continued to perform its true function: protection at the top, exposure at the bottom. The system was not designed to fail. It was designed to survive collapse. And as debt expanded globally, as financial assets outpaced real economic growth, and as wealth once again began retreating into silent jurisdictions, the lesson of the past grew impossible to ignore. Crashes do not come without preparation. They arrive after wealth has already moved. And somewhere, far from public view, the next transfer is already being rehearsed. By the early 21st century, the world believed it had entered a new financial era. Technology promised efficiency, data promised precision, algorithms promised the elimination of human error. Markets moved faster, information traveled instantly, and risk appeared measurable, manageable, even conquerable. But beneath the innovation, the old logic remained intact. Modern markets grew on the same foundation as those before 1929, confidence fueled by leverage. Debt expanded not as a warning sign, but as a growth strategy. Governments borrowed to stabilize economies, corporations borrowed to inflate valuations, households borrowed to maintain living standards that wages could no longer support. Once again, growth outpaced reality. Central banks became the invisible engines of the global economy. Interest rates fell to historic lows, then below zero. Liquidity flooded markets under the promise of stability. Crises were no longer allowed to fully unfold. They were interrupted, postponed, softened. But intervention came with consequences. Artificially sustained markets lost their ability to self-correct. Asset prices detached from fundamentals. Stocks, real estate, and speculative instruments rose not because of productivity, but because capital had nowhere else to go. This was not prosperity, it was pressure. Behind public optimism, institutional behavior told a different story. Large financial players hedged relentlessly. Exposure was insured, reinsured, and transferred. Risk was sliced into pieces and distributed across systems so complex that no single participant could see the whole picture. And yet, those closest to the core always knew when to step back. When volatility appeared, retail investors were encouraged to stay calm. Long-term narratives were promoted. Meanwhile, elite capital quietly reduced exposure, shifted into hard assets, and positioned itself for turbulence. The pattern was familiar. Crises in the modern era no longer began with panic. They began with silence. A liquidity freeze, a technical malfunction, a sudden repricing that algorithms amplified before human decision-makers could react. The public experienced shock, the system executed protocol. Each major disruption revealed the same truth. Protections existed, but not for everyone. Emergency lending facilities were created overnight for institutions deemed essential. Markets were stabilized not to protect participants, but to preserve structure. Losses were absorbed socially. Stability was privatized. For ordinary households, the consequences were slower but heavier. Savings lost value through inflation. Housing became inaccessible. Job security weakened. Economic anxiety became permanent, normalized as the cost of progress. And yet, the narrative endured. Technology would save us. Markets would correct themselves. This time was different. But history whispered otherwise. Just as in 1929, warning signs multiplied in plain sight. Debt ratios exceeded historic levels. Productivity lagged behind valuations. Speculative behavior surged under new names and platforms. Confidence replaced caution. And just as before, wealth began preparing quietly. Gold re-entered vaults, strategic assets were accumulated, liquidity was positioned where exits were fastest. The public saw innovation, the insiders saw fragility. The modern financial system did not eliminate the ghost of the past, it refined it. The same mechanisms of protection, concealment, and consolidation simply moved faster, operated digitally, and hid behind complexity. The same winners remained closest to the switches. The same costs flowed downward. When the next fracture comes, it will not resemble 1929 in appearance. There will be no shouting traders or falling ticker tape. It will arrive as a technical event, a policy shift, a temporary disruption. But the outcome will feel familiar.
Because the ghost of 1929 does not announce itself. It waits for belief to outweigh caution, for leverage to replace value, for confidence to blind memory. And when that moment arrives, those who understand the system will already be gone, leaving behind explanations, reassurances, and narratives meant to calm those who remain. The question is no longer whether the cycle continues. It is whether anyone recognizes the warning before the silence begins again.
Every financial system eventually reveals what it was truly built to protect, not in moments of stability, but in moments of stress. When pressure rises, when confidence fractures, and when intervention becomes unavoidable, the hierarchy of priorities becomes visible. History has already shown the answer. The architecture that emerged after 1929 was not designed to prevent collapse, it was designed to manage it, to control the direction in which damage flows, to ensure that when the system bends, it bends away from concentrated wealth and toward those least able to absorb the shock. This is not a moral judgment, it is a structural reality. Modern economies are bound together by debt, sovereign debt, corporate debt, consumer debt. Growth is measured not by resilience but by expansion, and expansion demands constant confidence. Once confidence falters, the entire structure depends on intervention. That intervention is never neutral. Central banks step in as lenders of last resort. Governments mobilize public balance sheets. Emergency powers are justified in the name of stability. And with each intervention, precedent is set, boundaries shift, what was once unthinkable becomes standard practice. The system learns. Each crisis strengthens the mechanisms of control. Surveillance increases. Financial flows become more traceable for the public, yet more protected for institutions. Regulations multiply for small participants, while exemptions quietly expand for large ones. Power does not retreat in crisis, it consolidates. Meanwhile, the language surrounding finance becomes increasingly abstract. Terms like liquidity support, market stabilization, and systemic importance replace discussions of human cost. Complexity distances responsibility. Decisions affecting millions are framed as technical necessities rather than political choices. And most people accept this framing because alternatives are rarely presented. The cycle continues because it is efficient. It rewards proximity to information, scale, and influence. It punishes exposure, dependence, and delay. Those who understand the architecture position themselves accordingly. Those who do not are reassured until it is too late. The ghost of 1929 survives not because it is hidden, but because it is normalized. Each generation experiences its own version of excess and correction. Each time the explanation sounds new, each time the outcome rhymes with the past. Yet history also shows something else. Moments of fracture are moments of clarity. They expose the rules beneath the narratives. They reveal who is protected, who is expendable, and who holds the keys to recovery. Awareness does not guarantee immunity, but ignorance guarantees vulnerability. The future will bring another reckoning. Whether it arrives through debt exhaustion, currency realignment, geopolitical fracture, or technological disruption matters less than how it is managed. The response will follow the same logic unless it is challenged. Because systems do not change themselves, they are changed when enough people understand how they work. The vaults will always exist. The exits will always be mapped. The question is whether transparency reaches them before the doors close. The ghost of 1929 is not a prophecy. It is a reminder. A reminder that finance is power, that crises are moments of decision, that history is shaped not only by events, but by who is prepared when they arrive. And when the next silence falls, when markets pause, screens freeze, and explanations begin to circulate, the most important movement will not be visible. It will happen quietly where it always has. In the shadows where wealth waits, protected by a system that learned long ago how to survive collapse. What happens next will depend on who is watching and who understands what they are seeing.